Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. With me today is Paul Lloyd. Paul is a certified financial planner and member of the ACT Advisors team. Paul has been doing some substantial research into some ideas for credit union leaders we think are a little bit different. So that's what we're here to talk to Paul about. Paul, thanks for joining me today.
Thanks for having me, Doug.
The initial research paper that you've produced is on what we're calling the action point, which is capital ACTION, action point. Tell me a bit about what the action point is and kind of a short summary of what our outcome is, and then we'll kind of get into the details behind that.
Well, action point we've determined is the point in time in an executive's working career where we feel like they've passed the threshold of financial plan success, where they've reached a point where even if the rich benefits that they have with the credit union were to go away, their financial plan would still be successful with a reasonable statistical level of confidence.
Are you telling credit union leaders that they need to be thinking about their own personal success before they decide how to lead the credit union?
Well, yes and no. We're not saying that you should put your personal financial plan above the needs of the credit union, but any bold initiative that a credit union leader takes in their career comes with some amount of risk. Sometimes that's a financial risk to their credit union. Sometimes it's a political risk with their board and their membership. But ultimately, that risk trickles down to them and their future employment. So if you have really bold initiatives that you like to take, it's nice to know, at least to give you some level of confidence, to know where your action point is. Know if things were to go wrong right now, would I be okay personally? Would I have to see a drastic change of lifestyle? So it's nice to have that information in mind so you can think about how that aligns with your credit union's vision.
So maybe what you're saying is that understanding some level of personal security is not where you start from, but it might enable you to sort of take it up a notch instead of just trying to grow your traditional lending portfolio. Maybe you get into some more non-traditional things because you have a certain amount of comfort that you're going to be okay. Is that what you're saying?
That's correct. And knowing where that action point is on the horizon can help you plan ahead. I mean, if any of these initiatives that you mentioned as examples, they take time to develop. They take time to come up with the resources and the talent to implement. So if you're in year 3 and you know that your action point is year 5, it's time to start moving. It's time to start taking on those steps to meet the goals you've set out.
Interesting. All right. So let's back up and start talking about what's normal in your work with credit union executives. So talk to me about the typical planning needs you see for credit union executives.
Well, like any other financial institution, credit unions are faced constantly with the challenge of attracting, rewarding, and retaining their top executive talent. So another consideration, too, is it's always difficult for highly compensated executives to save enough through traditional means to provide the kind of income replacement they need in retirement. So those two factors are always big on the minds of credit unions. And so as this executive benefit market has evolved over the last 30 years or so, we've seen quite a unique mix of benefits that are common amongst credit unions across the country. And there's really not a lot of education out there for those executives. They're aware of the resources they have, but are not really sure how to utilize them and all the timing implications, the tax implications. So, I think if you were to ask the average financial advisor out there about a collateral assignment split dollar plan or a 457F plan, you probably wouldn't find a lot of familiarity.
Let's start with that here. So I know the 3 types of executive benefits that we commonly see is 457B, 457F, and collateral assignment. So talk to us just a little bit about each one of those plans.
The 457B plan, I think, is the most common that we see. And that's basically a non-qualified deferred compensation plan. And it's a defined contribution plan, just like the 401k. Contributions go in on a pre-tax basis, then are taken out of retirement. These contributions can be entirely from the executive, or they can be entirely from the credit union, or a combination of the two.
How much can we put in there?
This year, you can put in 19,500 or 26,000 if you're above age 50. Same limits that you have for 401ks, but it's an additional limit. The executive can save much more that way. One of the important considerations that comes into play with 457B plans is that those assets are technically assets of the credit union. So we typically see executives that like to get that money out of those plans as soon as possible in retirement so it's not at risk of forfeiture. But we have to weigh that along with their other benefits and how they work together.
When you put a 457B plan in, can you pick and choose who has eligibility for that?
Well, it's typically your most highly compensated executives in the organization.
Well, let's switch gears and do the 457F. Talk to me about that one.
The F plan is much like the B plan in that it is also a non-qualified deferred comp plan. They're a little bit different in that the vesting is typically tied to a date in the future, usually retirement of the executive. So it's used more as a retention tool than the B plan is. So contributions are typically from the credit union only in these plans and are set to pay out, like I said, at a date out in the future. It can be invested in the same ways that a B plan would be.
You know, it's interesting. I was working with an executive yesterday, and he had a serial F plan. It was paying out in sort of waves. He had a payout to last year, and he runs a large credit union, and so his total comp was about 1.1 million last year. So when that happens, talk to me about the excise tax.
Well, the Tax Cut and Jobs Act of 2017 brought in a 21% excise tax on compensation exceeding $1 million in a year to any one of a credit union's top 5 executives. In 457F plans, the vesting and payout of those is counted in that calculation. So it's very easy for a executive to exceed that $1 million threshold if you have a large F plan paying out in a year. On the flip side of that, collateral assignment split dollar plans are not subject to this excise tax. So we've seen those grow quite a bit in popularity in recent years.
The collateral assignment plan, obviously, that's the one that we see the most of and has a lot of power. So talk to me a little bit about how collateral assignment works. I know you've got a whole separate research paper going deep on collateral assignment, so we won't go deep here. Just talk to me a little bit about how it works and then some of those really interesting domino effects that you see in your financial planning work.
A split dollar plan is basically just an agreement between a credit union and its executive that dictates how they will split the benefit dollars from a life insurance policy. And this is always a cash value life insurance policy, which can mean a whole life policy, universal life, what have you. But in short, the credit union makes a loan to the executive to make premium payments on this large life insurance policy. And then it will build enough cash value over the years so that when the executive retires, they can take a pension-like income stream from that policy, which is entirely tax-free. That's something you just don't see out there, tax-free income. So it's enormous benefit, which opens up a lot of doors to other planning opportunities that might not have otherwise be available to them.
And is there a retention effect from collateral assignment?
Yeah, in the same way that an F plan would define a date in the future for vesting, the split dollar plan does as well. You typically have a defined access date in a split dollar plan, which defines when the executive can start taking income payments. Those ages are typically set in your early 60s, kind of your typical retirement ages. That's what you normally see.
I don't think I heard much about those domino effects. Tell me a little bit more about when you see these. You know, the executive has the collateral assignment, so she's got this income stream coming in retirement. Tell me about the extra effects of having that tax-free income.
One of the biggest benefits is the tax-free income in retirement for the executive. Another one that I failed to mention earlier is a death benefit from that insurance policy. Part of the death benefit goes to pay back the credit union for its investment, but the executive's heirs also receive some of that benefit too. But there are also some opportunities that you don't really think about that are on the surface that become available because of the low income tax rates that these executives see in retirement. Many of these executives see effective tax rates in the mid 30% range in their later working career. And then all of a sudden, they turn 62, retire, and start receiving split dollar income that's tax-free, and they see their effective rates drop down sometimes into the single digits. So this opens up several really important financial planning opportunities. One of those is Roth conversions. That sometimes leaves the executive with many years until they start having to take required minimum distributions where they can convert some of those pre-tax assets to Roth. Also, health insurance is a major consideration for executives in early retirement before Medicare starts at age 65. So in many cases, executives can draw a really rich tax-free benefit from the split dollar plan, but also have adjusted gross income in levels that qualify them for low-cost health insurance through Obamacare.
Okay, Paul. So these tools, the 457B, F, collateral assignment, are used to kind of fill in the ability of a credit union executive to replace a reasonable portion of their income, and for a sort of golden handcuffs plan, because the war for talent is real, right? And you need to keep your top leaders in the credit union so that you have that continuity for long-term strategic decision-making. So if you understand your action point, which you defined as the point at which you have some level of personal financial surety, even if you had a change in employment situation, can you kind of walk us through an example of how you would sort of test that and show how that works without too many details, since we're on the audio-only recording?
In our paper, we used the example of a fictitious credit union executive who has kind of an average level of retirement savings and assets that we would see. This is a 50-year-old executive who's been given a split dollar plan payable at age 62. So there's basically a 12-year vesting schedule. So this person becomes vested in their benefits 1/12 per year over that 12-year period. So basically, we stress tested this plan just like we would a financial plan for any other unexpected occurrence like death or disability. That's something you see all the time in financial planning. But I think in many cases, we take a situation like this executive and say, all right, they're given this 12-year vesting period on split dollar plan, their financial plan set. We look at the benefits that it's going to provide, and we look at that as a given, and we call their plan a success. But 12 years is a long time. While the benefits are extremely rich sometimes in these split dollar plans, they're certainly not without risk. That's a long time to have to wait. So things can go wrong between a credit union and executive. So we basically looked at what would be the effect if termination of employment happened after each year in that vesting schedule. The planning tool that we use is a cash flow based tool that uses a Monte Carlo analysis, which is a fancy way of saying it's a probability tool that takes all possibilities of stock market return into account to come up with the probability of success of your plan. So we look at what is the probability of success after every year in that 12-year period if the executive were to be terminated from his position and lose the benefits that are unique to the credit union, that lose the ability to save into a 457 plan and lose at least partial benefits of the split dollar plan.
So you analyze the percentage success that they would have towards their retirement income each year. And so you're looking at an increasing percentage, I would assume, over time as that vesting increases. Mm-hmm. So where is the action point in that continuum, and how do you behave differently if you're past that point?
Well, in the example, we used year 5 as the action point. And this is the point in time where the Monte Carlo probability of success exceeded 85%. In the financial planning world, that generally considered a very strong probability, but it can also be subjective and be up to the executive as how they feel about risk. And one executive might think 90% is a better number to shoot for, but whatever number you have determined as your action point, I feel like this is the point in time where you can feel a little bit more comfortable in your own plan success and use that to drive a more ambitious agenda for your credit union.
And I know from the work that you've done that you could use a statistical action point, or you could kind of back it into a dollar action point, right? Where instead of saying, all right, it looks like you're above an 85% chance of being able to replace, let's say, 60% of your final average salary. Well, yeah, that's a very typical goal. Instead of that, you might be able to say you could produce X amount of dollars with a reasonable statistical likelihood, right? You could switch it to dollars if that was more tangible to the executive and say, all right, here, you can produce this amount of retirement income at this point, and maybe the executive has some comfort with that figure, and then can work back into, all right, you're safe enough now to change jobs or to really get aggressive in some of those things that can drive the credit union forward.
That's true. And I really think that the biggest factors about this is just coming up with your base financial plan to begin with. That's the most important first step in all of this, is laying out your financial life. And as the way you see it will happen, that's your baseline goal that you're aiming for. And then we can do these year by year testing analysis to find out, where that action point is. And many times when we start working with clients, they're already past that point, which is great. It's nice to know that you're already there and can take the action that you need without hesitation.
So, Paul, I know you spent a lot of time working with credit union leaders and thinking about what's going on in the movement and of course, the intersection with tax policy, with what's going on in the market. Tell me about any kind of new ideas, what you see coming forward, or other research items that you would direct our listeners to.
We have already created in the past year some webinar content that's out there about potential impact of President Biden's new tax policies. That has evolved some over the last several months. So as we see that coming closer to some finality, we'll update some of that content with what has actually been implemented. We also have some other content out there that involves Roth conversions, Obamacare access that results from some of these split dollar situations. One thing that we're constantly working on is collecting data on the executives that we work with to try to find trends in their own personal finances that we can identify. But it takes a lot of data points, and that's something that is kind of an ongoing project for us.
Awesome, Paul. Well, thanks for joining us on See You on the Show today, and thank you for your work helping the leaders of the credit union movement.
Thanks. Good to be here.
Listeners, you can read our latest research paper on the action point on our website, act-advisors.com. You can find it on our blog, along with all of the other educational content mentioned in this episode. That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.